Ladies and gentlemen, good day and welcome to the Strides Pharma Science Limited Q4 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Singhal. Thank you, and over to you, sir.
Thanks, Yusuf. A very good evening, and thank you for joining us today for Strides earnings call for the fourth quarter and full year ended financial year 2023. Today we have with us Arun, Founder, Executive Chairperson and Managing Director, and Badri, Executive Director, Finance and Group CFO, to share the highlights of the business and financials for the quarter. I hope you've gone through our results release and the quarterly investor presentation, which have been uploaded on our website as well as the stock exchange. The transcript of this call will be available in a week's time on the company's website. Please note that today's discussion will be forward-looking in nature and must be viewed in relation to the risks pertaining to our business. After the end of this call, in case you have any further questions, please feel free to reach out to the investor relations team. I now hand over the call to Arun to make his opening comments.
Thank you, Abhishek. Good afternoon, everybody, and thanks for joining today's earnings call. I'm pleased today to report a very strong performance from Strides, and considering how we began this year with starting off with just 4 crores of EBITDA in the whole of last year. Not only did we come back very strongly, but we achieved many firsts, as in we have now reported our highest ever annual sales. This is at 3,700 crores, about 20% over last year. At 990 crores, this is our highest quarter ever reported, up 14% sequentially. At $232 million, our U.S. business has increased from $157 million and has now surpassed the pre-COVID period sales quite significantly, and we are delighted with the performance and also the calibrated reset that we have achieved in the U.S. market. Also pleasing to note, led by our UK operations, the other regulated markets have also achieved its highest ever quarter at $48 million, and at $157 million, that again becomes the biggest year we have done since we got into this market. In Q4, our gross margins inched very close to our historical peaks of 60%. Our focus this year, while we were pulling revenues up quite significantly, was to get to our historic gross margins, and I'm very happy that in Q4 we are just a few bips below that internal target. During the year, important outcomes included a revenue growth of almost 600 crores, an absolute increase in EBITDA of gross margins for almost 500 crores, and from a 4 crore EBITDA in the whole of last year, we have grown quarter on quarter, focusing on costs, product launches, and the discipline that this business requires to have increased our EBITDA to 446 crores, and with Q3 EBITDA at 160 crores, while the percentage out of that EBITDA is not yet to our targets or our historical targets, which are about 20 to 21%. But I'm pleased that we are inching very close to that, and as we reset our business even further and complete all the work that we commenced in April of last year, I'm very confident that we will continue to build momentum from here on. We have reduced the gross debt by about 250 crores during the year, and that is a significant improvement on our debt to EBITDA ratio. In Q1 of this financial year, we started at 8.3 times, coming from a very dismal FY22 to an annualized exit run rate of 3.4. We did call out that our target would be closer to 3, but as you would imagine, bulk of our growth has come from the U.S., which all of us know is high capital and long gestation. So consequently, we are very close, and later you would see that we have guided will be under 3 this year. Also important that while we've had significant challenges with our Sputnik vaccines in our Stelis associate, we have reduced debt by about 470 crores. Consequently, in the group, we have reduced debt by about 720 crores in FY23, and this will continue to be for the company in the years to come. In a very difficult regulatory environment, I am very pleased to confirm that we have now received our closeout EIRs for all our sites that were inspected during the financial year, namely our Chestnut Ridge, New York facility, our flagship Bangalore plant, Singapore, and most importantly, the Puducherry facility, which had a warning letter in 2019. Although we completed remediations fairly quickly, considering COVID and that the plant does not deliver any significant shortage products, we had to wait for the new GDUFA regulations, which allows companies to request for inspection. And we are pleased that the inspection happened, and we have now got official confirmation from the FDA that they are satisfied with the remediation that we completed, and the warning letter has since been lifted in the last couple of days. This will obviously lead to a few more product approvals from the site, but product approvals has never been a concern for the company, considering that we still have 280 odd products filed and approved, but we only have commercialized approximately 60 products in that region. And that is because we want to have the luxury of letting go of a product or revenue when challenged for price. And this way we become not necessarily the primary supplier most times, but in the US, but it allows us to keep the margin and the price discipline that we want. We started off this year internally resetting the organization, recalibrating our growth strategies, our priorities, our capital allocation methodology, our focus on governance. All of that is playing through, and I'm very pleased with the results, especially during this quarter. So I touched upon the revenues of the quarterly performance, so I will leave that for questions later and get to the specifics in terms of the markets. Regulated markets continue to be leading the business. We currently classify our access/institutional business along with our emerging market play, and therefore you will notice the lumpiness of that business is very dependent on the contracts that we win, and it is not necessarily a steady state business. It's got lumpiness. Consequently, you will notice in future slides how we propose to mitigate our commentary about going forward from this year, so that investors can get a better view on how we present our case of our emerging markets. In fact, adjusted for the access market, emerging markets is a key focus area for the group, and it continues to grow quite well. So all markets grew well. Emerging markets, for the reasons that I explained a little while ago, de-grew, but the core emerging markets actually achieved significant improvements, albeit the base being quite low. At $232 million, we are somewhere in the middle of our 220-240 guidance, up from 157. Obviously, that has been a bad year because most of you know the Strides focus on niche acute therapies. COVID behind us obviously means that these businesses have now come back to historical levels, but interestingly, we see the number of players actually dropping in smaller acute therapies where we specialize in. It has been an exceptional growth from the other regulated markets because we are very determined to ensure that our other regulated markets catch up with the U.S. in terms of revenue so that we have a mirrored market opportunity. So we like the growth and we believe that we'll be able to continue that momentum. It has also been a fairly good year from the institutional business. We have been awarded a slightly higher share of the wallet, but the wallet keeps in terms of pricing pressures and others in their antiretroviral business. It's always a business we conduct for manufacturing recovery and overhead absorption rather than us building this into a strategic large business, considering that we are not fully integrated, unlike some of our peers. Importantly, our emerging market play, especially in Latin America and Asia, is going through the filing, regulatory, and partnering phase. And towards that, we launched a new division within Strides called Synergize, which is our B2B business that partners with companies worldwide, especially in markets where we don't intend to front-end ourselves, unless it's a frontier market of Africa where we are heavily focused on building a large pharmaceutical business, considering that it is a market still unpenetrated and we have a lot of success and experience in that market. Because we have this very large U.S. portfolio of approved products, we see with mutual recognition quicker approvals coming our way. Of course, we have to do a little more work in terms of different types of packaging formats that are sold in Latin America and Asia, but we do see this a pivot for us to grow even stronger. These were traditionally markets that we shied away from earlier, but last year we consciously invested in building out the emerging market play. Coming to market specifics, the U.S. at $232 million. Most importantly, 19 of our 60 products that are commercialized, we are number one in terms of market share. This is something we specialize in defining very niche and small products and then take market leadership to avoid the price pressure that happens for chronic and large volume products. This was traditionally a till 2019 strategy. We just reset it to what it was, and that's playing out well. We have 60 odd products which are going through very aggressive improvements before we launch these products. So we are very, very comfortable with the range of products that we have identified that will be launched in the near term. So most importantly, we like our market share, our price discipline, and also the ability to keep 3 consecutive quarters of $60 million plus. That's very important because, as you know, that the U.S. working capital cycle time is about 200 plus days, and we wanted 3 or 4 steady state quarters before we step up the gas in terms of expanding the market so that we could use the free cash that generates out of the U.S. business for its growth. The U.S. business otherwise is it's for almost $1 of new sales, including depending upon the working capital cycle time. Based on the working capital cycle time, it is a very capital intensive business, working capital intensive business. So we continue to stay invested. Synergize, which is our partner business, is a larger part of our growth strategy even in the U.S. And we combine with our very efficient front end. We believe that we are poised for even more success with our strategy, which is highly differentiated from our competitors, especially India-based competitors. The other regulated market was mainly led by a reset in the UK. We have great leadership in the UK and in our partner business, and we've got those businesses have bounced back to historical high and we're delighted with the fact that in the rest of Europe, we have now partnered with marquee names, and almost 3 of the top 5 companies are now our partners, which would never be the case when we were front-ending ourselves. So strategic alliances and partnership and leading in several markets that we don't intend to front-end is key to our growth strategies going forward. We're also investing most of our R&D spends in markets away from the U.S., considering that we have very significant approved portfolio. But having said that, we announced a partnership with Aviclar to develop a range of controlled substance nasal sprays from our Chestnut Ridge facility, which has those abilities to produce very complex products in nasal sprays. And we are very excited about this partnership and look forward with product filings and approvals in the near term. Our branded Africa business maintained its growth trajectory. It is subscale, but we think that we have established a long-range plan to take that business to an important size. And we, at this time, are not in a position to exactly give more details around it because LRP is still work in progress. But we're very excited about the opportunity, the margins that business provides us, and also the IMS leadership position that we have in many markets, specifically in French Africa. We have now also embarked into the English-speaking Africa, but only in selected markets, and we are also happy with the progress that is being made. Now, reflecting our reset, we have decided going forward to restate our markets into regulated markets, African emerging markets, and access markets. And for the benefit of our investors and the analyst community who follow us, we have recast the numbers for easy reference, and going forward we will be using this format so that you'll have more granularity on both our strategy and our numbers flowing through. We normally don't do a guidance, but we have, considering we're coming back from a very difficult period, we want to give all our investors the confidence that the leadership and I am very committed to build Strides to a very significant player, mostly focused on niche portfolio and margin expansions. So we want to give comfort to our investing community that, and therefore we have given a framework guidance where we say the continuing business will grow quite significantly, but our emerging markets will grow faster as we get more and more products approved. We are confident of increasing our EBITDA from 446 crores to about 750 crores in the upper range, and about 750 crores in the upper range, and 700 crores at the bottom of the range. Between Strides and Stelis, we intend to reduce another 500 crores of debt, and we are now very confident that Strides net debt to EBITDA will be under 3 times. All of this will be achieved through emphasizing our network optimization, new product launches, market expansion, branded business increases in Africa, and improved cash flow generation, which will lead to a stellar, a strong, if I may say, FY24. And we are all excited about our current order book and our confidence level. On a high level, I will also take you through the debt book, and then I will leave the house for questions. Debt, as you can see, we have given a little more granularity around debt. Our long-term loans have reduced by about 250 crores. Our working capital has not increased in spite of a 600 crore increase in revenues. Our gross debt consequently has come down We have increased slightly our revolver because Q1 for us is about $45 million, but Q2 onwards, we have been hitting approximately $65 million. Ideally, the revolver has got no recourse to India. This could be akin to a factoring facility, but considering our loan agreements, we are what we are doing as reporting them in that our debt book is the right thing to do. So we continue doing that, but we just want to call out the revolver, which was renewed a couple of months ago for another 5 years. It has got no guarantees or recourse to India, and our focus would be to reduce the long-term loans. Now, the ironic situation for us, our long-term loans has got a repayment of only around $15 to $16 million a year. So even as our cash generation is much more than that, we'll now start dipping our working capital loans, considering some of these loans are at good cost, and where LIBOR is today, obviously the cost of money has increased quite significantly. So a high-cost debt is what we would reduce through a combination of strategies. So adjusted for Forex, on constant currency, there hasn't been any significant net debt increase, while the business has delivered almost 450 crores of incremental gross margins. So overall, a very solid outcome, and we continue to be very bullish about the prospects of Strides and its continued focus on optimizing its business. I will also address Stelis as its material. Most importantly, during the year, we reduced peak debt from 1,200 crores to now 660 crores at the end of March. And this is in spite of a very significant impairment, mainly out of Sputnik. And while we have commenced arbitration in London, given the geopolitical situation, we have no clue and idea when this will get done with, but we'll keep the investor community updated on progress. We have taken the hit, moved on, focusing on building a world-class CDMO business, and we have several highs, including 2 US FDA inspections, EU GMP, our first product approvals for PTH, and we have now partnered in over 19 countries, covering almost about 80% of the market opportunity, and we would soon be closing out our partner in Europe and expect to launch the product within this financial year. We have added 5 new partners in our CDMO business, and I'm pleased to let you know that 3 of these 5 new partners are amongst the top 10 companies globally, and we have now a sum total of around 20 partners. We explained this business earlier with more graphical explanation that we start off with what is called a master services agreement, where we start work for a partner, and it can a master services to a commercial sale can take as little as 1 year for a product which is already approved, 3 years if it is a filed and approved product, to be approved product, and if it's an NBE or a biosims, can go as up to 10 years in some cases. So most critical for Stelis is that we can now confirm that we will be EBITDA positive. We will still have a little bit of challenges around the mismatch on cash flows. We're resolving for many of those things, and the Stelis board has appointed strategic advisors for reset. We will announce all of that outcomes with our Q1 results in a couple of months from now. And also importantly, we've just completed installing additionally 8,000 liters, of which 4,000 liters is commissioned, of drug substance, and our first multi-million contract for an MSA for a biologics us being secure, while we also have other customers that we have signed up. Post our FDA approvals, our average size of RFQs have increased dramatically. But like I said, onboarding of a customer takes anywhere from 18 months because it's not only GMP audits, but it's several other audits in terms of computer systems, ESG, EHS, the whole works. But onboarding customers take time, but once they're onboarded, it obviously is a very exciting business to be. So we are committed to this business. We are heavily invested in this business, and we'll stay invested here as we believe that the upside opportunities for stakeholders are significant. So based on now, and I'm also pleased to let you know that our first commercial sales will start in June, as one of our partners have now received 2 product approvals from this site post our FDA inspection. Consequently, while our revenues will be lumpy because our revenue recognition is a function of work done, we should be able to have complete coverage of our operations. From an operations standpoint, we will be not only cash positive, but slightly more than needs, but we still will have to work on finding the last leg of the solutions related to sales, and we're working very hard to ensure we get there. Bear with us. Last week of July, first few days of August is when we believe that we should finally be able to present to shareholders what we think would be a very exciting outcome for a business which is significantly valuable in the medium term. So with that, we will take questions. I have with me colleagues Padri, our CFO, and Vikesh, and we're more than happy to address your questions. And like always, if for want of time or if you have follow-on questions, please do write to us on our emails, and we'll be more than happy to address them. Thank you all, and most importantly to many of our investors who stayed invested, believing in us and believing in the story. We're delighted with our Q4 numbers, and we look forward to pleasantly surprise you with more good news in the near term. Thank you.
Yusuf, can we take the questions, please?
Thank you, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Mr. Dhruv Maheshwari, individual investor. Please go ahead.
Hi, I just have a couple of questions. The first one, it's good to see our US business has maintained its quarterly run rate in line with the last quarter and our guidance. Could you give a growth outlook for the same over the next 2-3 years? What would be the key drivers of growth for the $232 million base?
Yeah, so we have a guidance. We have mentioned that we will grow the business at around 15% with the emerging markets growing greater. So that is the benchmark guidance.
I got it. The second one is, has the Endo facility achieved break-even at an operating profit level during the quarter?
Yes, it has.
And the last one, from a portfolio build-out perspective, how should we look at the R&D investments for the business going forward?
Well, considering we have such a large basket of approved products, we have redirected our R&D spend to emerging markets and to Europe. Consequently, our R&D spend, which historically used to be about $20 to $25 million, has dropped to about $12 to $13 million.
Got it. Thank you so much. That's all.
Thank you.
Thank you. Before we move to the next question, a reminder to the participant, anyone who wishes to ask a question may press star and 1. Next question is from the line of Cinderella Carvalho from JM Financial. Please go ahead.
Thanks for the opportunity. Can you help us understand the U.S. market from our product perspective today? What has changed which is allowing us to sustain the ongoing market quarterly run rate? And if I look at our gross margins, are they entirely supported only by the U.S. market today, or you expect these improvements to come from other markets as well? So first on the U.S. market and then followed with our strategy.
So, Cinderella, you're not very audible, so I would appreciate if you could speak up on the phone, especially with regards to the first question.
Okay.
I got your second question, though.
Is this better?
Yeah.
Yeah, so I'm trying to understand the U.S. market from our product basket perspective, like from our product basket, how is the scenario today? What changes have happened which has helped us to sustain the ongoing run rate and grow apart from the new launches? Is there any change? Is there any supply issues which are helping us to, maintain our market share in the existing products? How should we see this? And from overall, our strategy in the U.S. market has been approach smaller size product, but higher in number. So does that work for us, or are you planning to change it?
No, we're not. In fact, we went back to that strategy, and I think some of our challenges were that we panicked during COVID as an organization and focused more on chronic, where there's a bunch of players competing for market share. And considering during COVID, acute globally dropped over 50% in terms of volumes because acute was not happening, elective surgeries were not happening at that time. Considering COVID is behind us and probably we are all binge traveling and doing all the things that we are normally used to do, acute has come back quite strongly. What has probably changed for us, to be very specific to your question, is we see that the number of players have actually reduced in the small molecules because all companies rationalize their portfolio because it's expensive to produce small products. It requires a great skill in terms of how you set your manufacturing facility, change over time, screening, validation. These are all very expensive cost centers given the current expectations of the regulators globally, but we have specialized producing these kind of products. The most important thing for us is I can now proudly say when I tell you that in 19 products, we are number one. We are number one by a very large margin. So we are talking at 40-50% market share, and we also cherish the fact that more than 70% of our number one portfolio has got no Indian competition for several years. So that is a key advantage where you can set price discipline. I'm not suggesting it just makes life a lot more easier when price discipline is there. You focus on supply chain. You ensure that your customer advocacy is great. We just brought all of that things, and it's not to blame anybody, but COVID ensured our logistics got very, out of whack and costly, and we got all that organized, and our failures to supply have dramatically started coming down. We never used to have one for almost 3 or 4 years pre-COVID. We had less than 0.5%, but COVID changed that for us and for a lot of companies, and supply chain is back to normalcy. Freight rates are no more exuberant. All of this plays. As far as gross margins, clearly for a combined gross margin of 60%, the U.S. is the gross margin leader historically for us. So if the business grew in the U.S. back from was higher than its pre-COVID level, then it's just a logical reset of a business that we did well for several decades we're just doing the same things. I think there would be always competition in specific products, but we are not shy in giving away market share also when we think it's irrational.
This is helpful. Arun, on our injectable filings, what's the update? Do you see any of them coming over FY24-25 this year? Can you call out some of whatever, at least in number, is for not exactly for that?
Strides doesn't work in injectables business at all.
We were planning to come back, right? That's the reason.
Yeah, we have plans. As I said, just hang on till we complete our conversations around Alex and his reset, and then maybe that would be more an appropriate time to have this discussion.
Okay. And overall price erosion right now, how much for our portfolio, and do you see for the overall industry where we are present from a U.S. perspective?
If I say zero, you won't believe me, but that's where I'm going to put my neck out.
For our portfolio, right?
Yeah.
That's how I should be. Okay. Thank you. And in terms of overall thought process over 25 and beyond, how do you think, or you think we should wait for 1 or 2 more quarters to ask you this question?
Yes, good idea.
Thank you. Thank you, Arun. All the best.
Have a good day.
Thank you. Reminder to the participant, anyone who wishes to ask a question may press star and 1. The next question is from the line of Taran Agrawal from Old Bridge Capital. Please go ahead.
Hi, good evening. Mine's a bookkeeping question. I'm unable to reconcile the changes in working capital that's been provided in the cash flow with the numbers on the balance sheet. For instance, increase in trade and other receivables is about negative 3,473 million for financial year 23. But when I go to the balance sheet, the receivables have not grown by that amount. It's grown by maybe only less than 100 million. Similarly, when I go down and I look at decrease in trade payables by about 1,022 million, I'm unable to reconcile. So can you just help me figure out what I'm missing here?
I'm going to let Vikesh, my colleague, to address this, please.
Yeah. So the major difference that is coming is on 2 accounts. One is we had deconsolidated UCL in Q2, end of Q2. So that is reflected in opening financials, but is not there in the closing financials. So that is having one impact. But in the cash flow, it is part of the 300 crores impact that you see on receivables and also corresponding on inventories and payables. Plus, there are certain assets that have been identified as held for sale, and those assets held for sale is also forming part of the cash flow bridge. So those are the 2 major items that are causing that are impacting the difference between the balance sheet and cash flow.
And the entire transactions pertaining to these 2 items will be presented in the notes in a much more detailed manner.
Okay, I'll have a look and I'll probably drop in an email. Thank you.
Thank you. Reminder to the participant, anyone who wishes to ask a question may press star and 1. Next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Thanks for taking my question. Arun, congratulations on the turnaround. I'll start with a couple of housekeeping questions. One is, there has been a pretty sharp QOQ increase in our other expenses. Any specific drivers for that?
Yeah. So Nitin, just to answer this question, the overall operating cost has remained the same. We had some the exchanges. There has been an increase in sales in the Q4. Correspondingly, there has been an increase in expenses. Plus, there is also an exchange impact which is sitting there.
And Badri, how much would the exchange impact be?
For Q4, it is 15 crore.
But given Arun, where the business today is, assuming at this run rate of about 1,000 crores of revenues, this 250 crores thereabouts is a SG&A expense number to go with, or there is a scope for rationalization over here?
Yes. So overall, we had said that it will be in the region of $208 million last time we said, and it will be in that range.
200
million.
200 million.
This is across staff costs and other expenses.
That's correct. Both put together.
Okay. And Arun, on the other regulated markets, there's been a very sharp delta in this Q4. So is there some seasonality in this business, or this is a base on which this business grows going forward?
No, there is a positive impact from our Australian business, which is mainly, the post-COVID, the Australian government mandates a certain level of stock keeping by the leading players in return for better PBS pricing. So we are seeing a significant uptick in Australia. We are not sure if this will be a yearly function, but will it kind of be a big Q4 event every year? We are not sure, but we are very confident to grow from the numbers that we have achieved in the regulated market of $157 million. But Australia did play a very significant role. But the exit run rate is 200 on a 157 million business, which effectively means that the average last 3 quarters was about 35. It'll be hard to beat this quarter, but we have very strong pipeline. Over the year, we will still achieve the company guided growth even in this platform.
Thanks. And on the US, you've talked about the fact that the US business currently the price erosion seems to be almost negligible on the current portfolio. So 2 things. One is is there again an element of seasonality in our US business?
Nitin, I'm not suggesting that there is no price erosion. We don't accept price erosion. We have the luxury of portfolio and size on what we want to achieve. So if you get challenged for a $10 million product or a $5 million product or a $20 million product, which is where the challenges happen mostly, we're happy to let go because we have 14, 15 products being launched every year. If we say that we have not lost business on our base business in the last year, that is not correct. We have, because we have given away business. But we've also added business because we are now very focused on going back to our historical numbers, which is US business delivers closer to 65 to 67% gross margin. This also addresses the previous question. But to get there, sometimes when you're challenged, you have to let go of business. So I'm not suggesting there's price erosion. Price erosion is when you want to keep your market share. I'm saying we have the luxury of letting go when challenged.
No, I got that. That's understandable. And secondly, in terms of the pipeline which is not launched yet, what you already have in the market, in your assessment, is there a qualitative difference in the quality of the products that you potentially launch versus what we already have in the market? In terms of when I meant it qualitative, I meant revenue per product potential.
Yeah. So I mean, a key element here is that out of the 280 odd products, almost 100 high quality products came from the endo portfolio. The challenge we had in the first 2 quarters of the transition was that endo was still marketing the products for us, and we didn't have control on products and portfolio and pricing because that's how the deal was structured. Now that we obviously have brought the same level of hygiene and discipline that we are generally known for in the US market. And that's also led to an uptick because we were bleeding money in Chestnut Ridge. And if I was addressing a previous question that did you make money in Q4 in Chestnut Ridge, and the answer is yes, it means that we have now solve for a lot of things. Most importantly, Nitin, we've reduced our Chestnut Ridge costs by almost $15 million during the year, and that complete flow through will only happen from April. Has happened only from April end. So that's almost about 8 to 10 crores a quarter, almost $1 million, $1.2 million per quarter. I mean, as in the residual cost that we are bearing in Q1. So that also will give you an indication of what Chestnut Ridge could do. So if you look at IMS today, you will see us in market leadership on several products. In many products, we are the sole supplier, but we are disciplined with pricing. We don't do anything irrational. But we have several products where we are the sole player in the market. But they're small products.
But two last questions. One is, when does the nasal spray portfolio partner recently start coming to the market?
Well, it's going to take us at least about 3 years because it's a very complex controlled substance on a very special device. So it's a lot of work, including potentially some clinicals if required.
And lastly, Badri, the interest cost seems to be very high for the quarter. Any specific drivers for that?
Yeah, so the interest cost is there are certain loans which has been taken in the later part of the Q3. The full impact has come in the current quarter. And second thing is, while we closed the transaction on Arrow on December last week, just because of this procedural matters, the repayment to the banks took time. So that's the reason the interest cost is slightly high. But overall, it will be that the 65 crore range is what we expect going forward.
65 crore quarterly range is what you should work with.
It's also to do with LIBOR, right? Because our Wells Fargo line is linked to LIBOR, so with LIBOR going up, there is a 3-4% increase on that line cost too.
Right. Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Congratulations, team, on a good set of numbers on the pharma side. So first question on Stelis, just wanted some more clarity. I think you have written that, we are expecting some outcome to come from the strategic options. So are we in the next, by the next quarter or so, are we concluding a transaction or planning to conclude a transaction, or are we just going to be deciding what is the way forward on what needs to be done for a Stelis stake that we have?
It's a more definitive way forward and how to ensure that we become a very important CDMO company of size and scale, and the strategic options include that amongst other things that you mentioned. So bear with us, it's only 2 months away.
Okay, because in the last quarter commentary, it appeared as if we wanted to conclude a strategic sale or something like that, wherein we sort of get out of our shareholding of Stelis.
You reading between the lines, but I can't blame you for that. When a board appoints advisors for strategic options, it effectively means it could be anything. What I'm trying to tell you is that anything for us in this case is how do we build Stelis to become one of India's leading CDMO companies, and what does it take us to do that?
Understood. So that is what we are expecting maybe by the time we have the results for the next quarter, right?
Right.
Okay. And secondly, what is the current level of corporate guarantees that Strides has given to Stelis?
The outstanding debt in Stelis is about 600 odd crores after cash and cash equivalents. I think the outstanding liabilities related to Stelis is in the range of around 500 crores because you don't need to give guarantees on all the COVID loans. So yeah, it is in that ballpark. Although if amongst the strategic options, the refinancing is what we want to do, then we have shareholder approval to issue guarantees up to 700 crores.
Understood. And now coming to the rationalization of the cost part, so we can see that, our other expenses have come down, but at the same time, some normative expenses would have gone up. So, what is the extent to which, we have gained in terms of permanent removal of the other expenses from our cost structure?
Yeah, so you have to assume your Q4 as a base, and like we said, $200 million run rate for the whole year, so $50 million. We are very close to those levels. There would be a little more opportunities for us to reduce, but it won't increase from there.
Understood. Because I think there were some higher expenses related to our US facility also, which we were carrying till end of April 23.
Yeah, so that was when we issue a warn notice where we right size more than 50 people. There are certain regulations that leads to fair significant amount of severance. All of that has been taken into account, and that ended as of end of April. So that's all done with now. Thank you.
Thank you. The next question is from the line of Zaki Nasir from Nasir Investment. Please go ahead.
Good afternoon, sir, and I think congratulations on a fantastic set of numbers. The company looks at the cusp of a turnaround in 24, as you rightly mentioned in your presentation, sir. My two questions, sir, is like we did around 1,000 crores on the top line this quarter. Going forward, do you think this will become like a normalized quarterly run rate for Strides?
Zaki, thank you for your commentary on our numbers. We appreciate that. We did have a good bump up on our institutional business, but we called that out in our deck where there is lumpiness in that business, and that's why we have agreed on a restatement on how we would present numbers going forward. So I think that the institutional business is lumpy in nature for the whole industry, for those of us who are in this business. But if you take that off, and we have guided numbers, then on that number, you could safely add 20%. So this is a good kind of guardrail number, if you wish, but I would be cautiously optimistic on the institutional business, because it's not a business in a hands is dependent on donor funding, on the ability for you to deliver at short notice and stuff like that. At this time, we are building businesses which are more in our destiny, in our strategy, and while the donor business is extremely important from a manufacturing recovery standpoint, it's not a business that is predictable or guidable like the rest of the business.
Okay, but sir, like the word you rightly used, like a guardrail number. So could we safely assume 6-7% from here on the lower end in terms of if you subtract a part of the institutional business also?
If you subtract the institutional business, you can safely count 15 to 20%. If you add the institutional business, 6-7% is also very comfortable.
Okay. And sir, in terms of Stylus, the debt number is 600 and odd crores. And what would be in Strides, and what would your comfort level or going forward by the end of 24 and 25, what would you want these two numbers to look like, sir?
Not over 3.5 times EBITDA.
Okay, sir. And one last question, sir. In Stelis, have we taken the total write-down from the problems on the Sputnik, or we still have some carry-forward things from that?
None.
Is there any possibility of something coming back on the books?
No.
No, I mean, in some kind of payback from the authorities or things like that? Okay, sir. Thanks a lot, and best wishes to you and Team Strides for 24 and a fantastic 25, sir.
Thank you so much. Appreciate it.
Thank you. Next question is from the line of Siddharth Chaudhary, individual investor. Please go ahead.
Hi, thanks for the opportunity. I just have a single question. So the guidance for FY24 is around 15% revenue growth with a target EBIT of around 750 crores. So could you highlight the key drivers for this top line growth and margin expansion for this fiscal year?
So one is costs, obviously. Second, continued success in the US. That is key. And synergize our B2B business, converting customers that were converted, moving to revenue recognition. Those are some of the key drivers.
Got it.
Thank you.
Thank you. Next question is from the line of Omkar, individual investor. Please go ahead.
Sir, good evening. Am I audible?
Yes.
Thanks for taking my question, and congratulations to Strides team for good gross margin improvement and operating profit margin in Q4. My first question is, Strides has delivered 63 million revenue in US. As far as QOQ performance is concerned, there is no improvement in US revenue. Any specific reason for it? And how many products we have introduced in this financial year from Endo? Till Q3 result, 10 products got launched from Endo in US.
Yeah. So it's not launched, it's actually relaunched. So like I said, if we get challenged on pricing, we are happy to let go. So it's not how much we want to grow in the US, it's about margin expansion. And with that discipline, we have got to 60% of margin expansion, almost 59.9. And we want to focus on that. And this year is all about improving our gross margins and EBITDA and further reducing our debt to a comfortable level, which is what our focus is. So we are not so much concerned if sequentially we didn't grow 10 or 15% Q on Q. We grew 58% Y on Y. So if we end up the year 15% growth on 232 million, that's what we need to look at. And are we improving our gross margin beyond 59? That will be a good indicator. Okay, thank you. Hello?
Thank you. The next question is from the line of Chetan from Pragya Equities Private Limited. Please go ahead.
I just wanted to know what percentage of promoter stake is placed and is there any guidance to reduce it?
Sorry, can you repeat it?
We are not able to hear you. Keep your headset closer to your...
Yeah. Can you give us what percentage of promoter stake is pledged, or is there any guidance for reduction if reduce it?
Yeah, so see, we did guide that our idea is to reduce our pledges quite significantly. But considering we had a choice last year to keep the lights on in Stelis, so promoters have invested over 500 crores, which to ensure that nothing is stalled from the guarantees that Strides has delivered, and that was key to our strategy. And absolute loan book on the pledges are not increased, but pledges is a function of the share price. We believe that we will be able to reduce the pledge levels by about 33% to 40% during this financial year. Okay.
Thank you.
Any other questions?
Ladies and gentlemen, this was the last question. I would now like to hand over the conference over to the management for the closing comments.
Thank you. Thank you all for joining today's call. And like I earlier alluded, thanks for your confidence in Strides, and thank you for your support.
Thank you. On behalf of Strides Pharma Science Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.